theme that you just spoke about, beaten down valuations but political change coming, does Brazil suit that definition better than India just over the last few months?
Over the last few months, I would say so. So the political situation obviously is quite acute in Brazil at present. It's the classic mix of conditions under which the equity markets can move very, very strongly over a short amount of time. However, we're executing a degree of reticence with respect to Brazil at present, and the reason is that simply the details of the politics. So there's reform afoot, there's a corruption probe afoot, and the corruption authorities are kicking out the corrupt politicians, but the problem is, who do they replace them with? The whole system is tainted. So this appears to us a scenario that's going to take quite a long time to play out, and may well involve disappointment periodically along the way. It's a tough job that they've got on their hands.
What about China? Because this year began with so much worry about it, and now increasingly we hear less and less about that. Do you think it's too optimistic or wishful to think that China's problems are behind us and there's a serious capex recovery underway there, or has the market got it right by betting on it?
I think that China's problems persist. I think what the government is dealing with in China is a very challenging problem. They are dealing with the aftermath of a debt boom, a huge debt boom. If you look at debt booms over the course of the last 50 years, China's is in the 97th percentile, so it's bigger than 97% of all other debt booms over the past half century across the world. So it's a big mess that they potentially have to clean up. Now, I think there's a cause for optimism for the following reason. The mechanism by which these debt build-ups feed through and cause a financial crisis is a political mechanism. So essentially, the job of cleaning up is one of bailing out the banks. Now, in a democracy, you can't bail out the banks until you've had a financial crisis. It's politically completely unpalatable. China, lacking a democracy, has a benefit from that, which is that it can bail out before the crisis. So China already is bailing out the banks. And what I think that does is it reduces the probability of a Lehman Brothers type moment in China, of a severe discontinuity in Chinese growth. So on the basis of that, I think that the risks in China are a little bit overstated, and I think that one can be a little bit more sanguine about the outlook there.
Speaking of the banking sector, India has also not covered itself in glory over the last couple of years with the problems of its banking sector. How do you see that problem shaping up? Because it's been a big hangover over our market as well.
I think it will remain to be so. I think that you ultimately are going to need to see, much stronger earnings across the economy in a broad-based way, and further treatment of the banking sector on the part of the authorities. So this is an overhang. This is one of the weakest parts of the Indian economy. And for us, we look elsewhere in the economy where there are lots of opportunities to be found.
How have we characterized this rally that we've seen from February to now in emerging markets? Some have been spectacular. In India, it's not been so powerful, but significant nevertheless. Is it just a recovery from beaten down ground and should be read as such, or is there something more meaningful or durable in it?
It's hard to say, because over the past 5 or 6 years, during which emerging markets have underperformed, have disappointed, there have been false dawns along the way. I think there's a little bit more substance to this one than we've seen in previous rallies. As I said, China is looking a little bit more steady, and I think that the Fed, the US Federal Reserve, has reprogrammed itself to be more globally aware, and I think that's only really happened in the past 6 months or so. It recognizes that it's to quite a large degree China dependent. You know, the Fed likes to talk about data dependency, but really it's China dependent. They can't hike unless conditions are relatively stable in China, and I think that's actually very good news for emerging markets, and I think justifies to quite a large extent the rally that we've seen so far this year.
You know, the bearish camp in the market for the last couple of years have been flagging one central concern, that all that we're seeing, the seeming stability right now, is because of what central banks have been able to achieve. But sooner or later, the world will figure out that they're unable to reflate the world. Either they'll give up or do something which is completely out of the book. Do you still see that as a major risk, that the markets lose their nerve or their faith in what central banks are trying to engineer across the world?
Yes, this is a risk, absolutely. Central bankers are experimenting. They're in uncharted territory in terms of the policies that they're currently executing. So that's a risk in itself. Also, these policies seem to be working less and less well as time goes by. So every time, you know, the ECB unleashes another, you know, bolt of quantitative easing, it tends to work less well than it did the last time, as did US QE 1, 2, and 3. So that is a risk. I think that what's needed is a pivot towards more fiscal in the mix. In recent months, the rhetoric and the debate seems to be shifting that way, and that is starting to become an accepted point of view, but the politics are still very, very tricky. Think about fiscal policy is it actually has to be administered by the politicians as opposed to the central bankers, and they're under you know, constraints and have considerations that are very, very broad in terms of in terms of the politics. So that fiscal pivot is really quite tricky.
So as an economist, do you see any signs, I mean, not forget the equity market for a minute, are there any signs visible which tell you that maybe the bond market or foreign exchange markets or gold is something telling you that there is a portent of growth actually not picking up as much as equity markets have started to price in? Is anything telling you that any market is sending a warning signal that maybe recession is not completely a zero probability?
I mean, you would have to look at the real return on bonds today, which suggests that growth is going to be almost non-existent, maybe over the course of the next generation. I wonder, though, if that's too pessimistic.
Which market usually gets it right between the bond and the equity market, in your views?
Well, people say that the smarter market is the bond market.
You don't agree?
I think that the bond market usually exhibits a bit more calm and almost a greater degree of introspection in the sense that the equity market is much more volatile and is much more prone to the waxing and waning of emotion. So in that sense, you would look towards the bond market for a cooler, more rational view. But I think at present there are special things going on in the bond market. I think that bond investors are cognizant of the concept of secular stagnation, the idea that the growth of the good times in the developed world is something that's in the past, and looking forward it's going to be much harder for economies to grow. You know, and second, I think that the bond markets are being dragged down actually by the institutional features of the Eurozone. So what you have in the Eurozone at present is really still an acute, I would describe it as an acute unemployment crisis. So you have 10% unemployment in France still. You have 20% unemployment in Spain, 12% in Italy, 24% in Greece. Now, the politics of the Eurozone load all of the obligation for dealing with this crisis onto the ECB. Now, the ECB only has a very blunt tool in the toolkit, really at the end of the day, which is to reduce one way or another overall Eurozone interest rates. Now, in doing so, they've reduced German bund yields down to extremely low levels that don't really make any sense on an economic basis. A 10-year yield at zero, a 5-year yield in negative territory. Now, German bunds, US Treasuries are substitutable assets. So German bunds drag down the yields on Treasuries. So then you get low yields across the world. But I think that you can look for quite a strong root of that pricing in the institutional design of the Eurozone.